So return on equity, return on invested capital. You know what's the difference to me? Return on invested capital is real similar to return on assets. So the key is, we talked last class about ATO times margin. That's somewhat a return on asset type of measure, where you're ignoring the capitalization of the firm, how much debt, how much equity you have. So when you bring return on equity, you have several things going on at once. So what is return on equity? Essentially net income over net worth. Most firms will use a 2-point average or a 5-point average. There's, several months. I remember at UTSA, we used a 2-point average, and the CFO of the life insurance company discovered that if he paid his dividend right at the very end of the year, his ROE would jump up 5-6%, like 20 to 26%, because they were using a 2-point average. And so he got that last number as low as possible. It kind of somewhat exaggerated his number. So guess what they did? They went to 13-point average, and that killed his whole idea. But he wasn't thinking how to improve the ROE as far as improving the company, but he figured out how to improve the ratio. So a 5-point, why don't we do a 13-point average on your companies? We only have quarterly data, so we can do that. So I only say that as if you pull this number from Bloomberg, what net income number are they using? Is it an adjusted number? And then what equity are they using? Is it an average of the 2-year period? Is a 5-point average? So you have to be careful of that. But in our purposes, I'm taking this year's net income divided by the end of year equity. So just be careful. You can get all different numbers depending, and it can be materially different. But I'm doing that mainly because it makes this calculation a lot easier to do. So we can break this up. So what the DuPont method said is return on equity can go up for good reasons, it can go up for bad reasons. What we want to do is break those different reasons out so that we're not fooled by the numbers, because someone has a high ROE might mean they're leveraging up with debt. And so here's how I do the formula. I do asset turnover times margin. That's the good stuff. The tax impact, that's the kind of the uncontrollable part, unless you're doing some funny business there. And then the leverage impact. We don't want ROE going up just because the firm is more levered, because that just means their beta is going to go up. Yeah, ROEs go up if you leverage up the firm, but so does required return on capital. The two should offset each other, except for what, according to Miller, Migliani. What's the one thing that doesn't offset? The tax shield of debt, right? So from that standpoint, but and here's how I calculate it. So it's sales over assets, that's asset turnover. You want that number to be higher. I do EBIT over sales, which is your EBIT margin. You want that to be as high as possible. What is this measuring here? Net income versus EBIT, EBT. What's the difference between net income and EBT? There's only one number missing. Net income is lower by what? By taxes, right? So if your tax rate's 35%, what should this number be? You pay 35% in taxes, so this number should be 0.65, right? This is what you keep after you pay taxes. So you hope your firm's number would be around 0.65. I'm hoping for your companies that this is a small number or not a volatile number. But if it's a big number, you may have to talk about it. Well, I'll show you how you have to do that. The corporate tax law has been changing quite dramatically, especially 2017, and it might change again 2021. And then this last one, EBT over EBIT, what's the only difference in these two? The interest expense. So if a firm has no debt, what should this number be? Should be not 0, but 1. So 100% of their income, they get to keep, none of it goes to the bondholders. Assets over equity, that's not debt though, is it? Asset over equity, there's more in the difference between assets and equity besides just debt. But we do call that the equity multiplier. I call it the financial leverage of the firm. So it includes all the liabilities of the firm for leveraging up the firm. But you would assume that there would be an inverse relationship between these two. So the more the firm uses debt, the higher that assets equity number will be. But then the lower this number is going to be because they're paying more out in interest. So those two should offset, but what usually dominates? This number usually has a much bigger impact than this number. And so as the more debt you have, and you know that's going to be the case, y'all remember the formula, as long as ROE is greater than the cost of debt, more debt means higher ROE, right? Y'all remember that from your corporate finance class. So if your return on assets is higher than cost of debt, throwing more debt in the firm, the ROE will just keep going up and up and up and up. Is that good? No, it's just the firm's just getting riskier and riskier unless you're talking about middle or declining and they're taking advantage of the tax shield of debt and that kind of thing. So, and what is ROA? Well, ROA for the most part is asset turnover times margin. So as long as the firm's earning more, if the basic business is earning more than what the bondholders require, then more debt will just make the ROE go higher and higher and higher. So it's an easy equation. Is management really adding value by doing that? Not really. It should somewhat offset each other. Their ROE is higher, but their cost of debt and their cost of capital is coming higher. So this is my formula. I've seen it in the accounting classes where they'll do net income here. And they won't take out the interest and taxes. And so what they call a margin, or they may take out the taxes, but not the debt. So what they call a margin includes the debt piece as well, which you don't want that. You want to separate the debt so it's entirely with the financial leverage. So I don't know what ratios is this. I don't know what classes y'all took this in. Where did y'all have? Well, I know y'all saw it like this because you had my class, but in your other classes, does this look the same? I'm convinced one reason finance students graduate, and it's,
I'm sorry.
we taught you all this, how can you not know? And it's because every class teaches it slightly different with different jargon, and we never explain that we're talking about the same thing. And students are like, is this something new or did it already have this? And it's just so irritatingly frustrating. So does this look familiar? I should have had this at least in 2 different classes already. Some of you are kind of shaking your head very kind of scarily in case I might ask you a question. Was it exactly this or is it slightly different?
Well, I would look at 3 pieces.
So where do they put the interest expense? Is it under the margin? Did they go sales over assets, net income over sales, assets over equity? Yeah, so yeah, I've seen that a lot in a lot of accounting textbooks where what they're calling a margin includes the deduction for interest expense. And that makes no sense to me at all. Why would you have assets to equity without combining that with the interest part? The taxes piece, you take that out because taxes is not operations. So that makes sense to me as well, but I'm gonna break that out. Well, this is the formula that we'll use. I'm doing everything on the balance sheet is the end of year number. Could you do an averaging number? You could, but it sure makes the equation much messier when you do that. Now, how would this ratio work with JP Morgan? Complete garbage. It would make no sense whatsoever. This sells the assets. Think about it. If you're interviewing with, I'm scared someone's going to interview with JP Morgan. They're going to talk about JP Morgan's turnover ratio. What is sells the assets for JP Morgan? Y'all ever thought about that? Why don't banks have turnover ratios? Why don't life insurance companies, property casualty, have turnover ratios? So when I was at UTSA, I actually had a database and I brought in all of our competitors and I did an ROE decomposition, but I had to radically change it and I couldn't actually multiply. I had some additions in there. So if you think, this is just in case you interview with the firm for a bank, well, let me do insurance because I know that better. So they have net income, and your net income is what? You got underwriting plus investments. And their revenue, anybody know what is their revenue? Premiums plus investments, investment earnings. Your assets are mainly what? Investments. right? So if you do revenue to assets, your revenue or premiums, that has nothing to do with your assets. So what would you look at? What I want to look at, investment earnings divided by assets. What's that? That's my investment return. I'd love to see that versus all my competitors. That'd be pretty interesting. But revenue to assets means nothing to a bank or an insurance company. It's not a number at all. So be careful on some of these ratios. That's why you see why I told you don't pick a bank or an insurance company, because the ratios don't make any sense. They're very different animals. So banks and insurance companies, they're spread businesses. They have assets that make money. They have liabilities that cost them money. And what are they trying to do? They're trying to make a spread on that. So a bank, charges 7% on an auto loan, and they pay 4% on a CD or whatever. They're making a 3% spread. A very, very different business. Okay. Now I can't think of any other business besides banks and insurance companies that have that problem, but I'm hoping none of your companies are in that issue. But yeah, it's a very different business. I've always believed that banks and insurance companies don't have free cash flows either. And I was always scared to say that. And then Dan Madaren said the same thing. And I'm like, all right, someone a lot smarter than I said that same thing. But it's hard to think of free cash flow with an insurance company or a bank. So just be really, really careful. If you're interviewing with those entities, don't start throwing all the stuff out there saying, I've had all this stuff, I'll impress them, because it not work. Right? But it should work with every other industry. So I wish I could show you the spreadsheet. Boy, it was a complicated spreadsheet, but I did a decomposition of ROE for an insurance company, but the one was massive because I had to separate the underwriting from the investments. All right. But you might think about that if your sales are all different businesses, and on the assets, there's assets that are very specific to one particular business. You're kind of mixing and matching when you're doing an asset turnover. So it can be a little bit tricky. All right, so we're trying to take the good stuff and separate it from the bad stuff so we can tell what's going on. So let's look at it, how I like to do it. So this is what I recommend you do. So load your firm, and you might try this, or do try this with me. So let's create a new sheet here. So to do this, what do we need? So let's go get our asset turnover. Okay, Bill Gates, I don't know why you're doing that. It's our asset turnover. What's the next piece we need? Hopefully I did an EBIT margin, right? So we do the EBIT margin. I'll just do. Bill Gates is responsible for that. So. All right, there's the EBIT. What do we do next? Yeah, let's go get taxes, the very, very bottom one. The last one we need. Financial leverage, which is right here. Bill Gates, why would you think I wanted to do that? Right, so this times this. Oh, I don't know if I have yeah, this includes this. Fine, I'm real messy with my terms. So this is both the EBIT, the net income over EBIT, no, the EBIT, EBT over EBIT, and the assets and net worth. It's the two of those combined together. If you look at the bottom of page 1, interest impact, the financial leverage, I multiply those two together. So they're both in that number. I don't know what to call it. I could call this the equity multiplier, I guess. So I just don't know what to call it. So that's the equity multiplier, but I combine the two. I think it's really important to combine the two together. So you see the impact of the interest on the net income, and you also see the leveraging impact. But you can just see with Walmart, there's the interest impact. I mean, it's pretty significant, right? I mean, a big chunk of their income is going to interest expense. But there's a leveraging, but if this number is greater than 1, what is it doing to its ROE? It's increasing it, right? So anything above 1 is increasing the ROE. So they're consistently, the leverage is increasing. All right, so we've got the 4 pieces. What we need to do is get rid of everything but Walmart. Oh, sorry, I should look at my charts. So these 4 charts should equal this chart. I don't know how the scale works, so I didn't look really at the scales. So is that large enough for you all to see? If someone wants, Eric, you want to turn off the light? I don't know, make it too dark in here. I don't know which one either. There's like 70 choices. It might be too dark. I don't know if I'll fall into sleep if they haven't already. Probably another one. There you go. Is that too dark? All right. Cameron falls asleep. Yeah. Turn it back on. All right. So we see the shape of ROE. It's generally coming down. There is one more I would like to do is the asset turn times margin. So I have that in there. So what we're trying to do is explain the shape of this. So on the surface, that looks bad. All right, their return on equity is coming down fairly significantly from 23% down all the way to 18%, even after COVID. So that's a fairly significant drop, almost a fourth. So why is it dropping so much? So let's look at asset turn on times margin. That looks interesting. Dropped a bunch. Why didn't ROE drop a bunch? You look at taxes, right? There's some strange things going on here. ATO and temps margin dropped a bunch, but the taxes improved a bunch. That's kind of strange. Why did the ATO temps net margin drop? That shape right there is the margin, right? There's something going on with margins. Sorry, there's chats going on. All right, ATO times margin is generally falling. It looks like ATO's the big culprit there. So most of this strange shape here is something going on with taxes. Where's my taxes versus my net margin. The two of them offsetting each other, and so we're not noticing in that. I don't know what that is, if that's an accounting thing related to deferred tax or something strange going on. But what you're trying to do is explain this chart. So asset turnover times margin has been generally declining, and it's gotten a little better here in 2021. Financial leverage has been fairly flat and it rose quite a bit. That's when they borrowed the money for that acquisition. It's improved here a little bit this last year. So if we look at this last drop, you can see that's almost all entire. I mean, it's entirely due to a drop in the financial leverage and in taxes. So the taxes actually go up. You know, you're dealing with some accounting issues, especially with Walmart and what happened to them with that subsidiary. So, but anyway, that's what you're trying to do. So if you put all these charts together, you're trying to get the story. One thing you're probably going to have to work on is the margins here, so you can get them so they're a little bit easier to compare, and that can make a big difference. We switch this to 2, it gives us a lot more shape. All right, so that's what you're trying to do here is try to get some story to go with return on equity, what's going on. Now, another way you can do this, which can be really powerful, is if you look at this ROE over time, it's dropped from, that looks different than my numbers. I don't know why it looks different than mine. yeah, that looks different in my numbers. I can't explain that. But if you look at the ROE over time, going from 16% down to 12, one thing you could ask is, what if their combined leverage have been the same every year? You actually can just take the combined leverage and just take it and put it in there, and then you can see it would have fallen from 14.3% down to 12.7. Versus going from 16.1 to 12.7. So their ROE dropped from 16 down to 12. That seems pretty negative. But if their financial leverage had been the same throughout the entire period, it would have only dropped from 14 to 12. So you can see there is a big part of that drop was the fact that they went from 158 to 140. So they improved the number quite a bit by bringing down that financial leverage. Now, the other thing I ask is how much of that is just because interest rates are so low? You know, they're borrowing money, interest rates are really low, so that can have an impact as well. So you can, on any one of these ratios, see what the impact would be. So you might want to ask, how material is asset turnover? So asset turnover, you take that last number from 16 down to 15 versus what if it was margin, not much of an impact. So the asset turnover is having a bigger impact. Going from 231 down to 221 is having a bigger impact. And you can just tell from the growth rate. The interest is down, partly because their debt is down, but also probably because interest rates are down. All right, so this is a challenging one because there's some accounting messes going on you're going to have to deal with. But your goal is get these charts in place and try to figure out, is there some story between this? What you're hoping is really the charts 16 and 14, you can explain the whole story. How much of the ROE is affected by the change in ATO times margin, and how much is financial leverage? Once you answer that question, then you go back to asset turnover and margin. You try to figure out which of those two is causing that. Hopefully you've talked about that when you talked about margin and turnover. You've already got that in your paper. You can just bring that forward on Walmart. I'm hoping most of y'all don't have major issues on the tax side, but you can see with Walmart, they got pretty material, 65% to 75%. That's a pretty radical number, especially in 1 year, going from 65 down to 75 down to 65. I do think, boy, that bothers me that the ROE is different. Mainly, let me show you why that's the case. On the ROE, and I shouldn't have done this, but we'll see. This may cause you a problem. But ROE, I'm actually pulling the ROE as reported on Bloomberg. Versus here, I'm calculating the ROE as net income divided by owner's equity, so that I can do the ROE decomposition. So that's why you have different numbers. And your numbers are radically different. I can't, there's nothing you can do about that. So hopefully the shape and all that is correct. If you really hate that, something that you could do, we might even try this. Data used for graphs. If you find the ROE chart, just say, you know what, I'm going to use these numbers. See what I did on the data used for graphs, chart 15A. If it really bothers you to have different numbers, then just change the numbers. So you have that now matches the numbers. Everybody see what I did? So graphs used for Walmart, data used for graphs. Line 103, that's the number that comes from the Bloomberg 5 versus 8. If I don't find it here. That might be, oh man, I'm glad I saw that. There might be, actually you should all do this, all right? And now That is not return on equity. That is actually pivot. All right, everybody on your spreadsheet, do plus. You go to print page 1. And hit line 51. Copy that over. Yeah, sorry about that. For all this time, boy, it's just good that you figure these out while you're teaching a class. All this time, I thought they were different because I was pulling Walmart's number, I mean the Bloomberg number, but that's not it. I was actually calculating. I just had the wrong line. Boy, that's everybody see what I did. So on your data for graph building, you need to change C103, the reference, print page 1, C51. That will fix that issue. Boy. All right, so now this looks more like the actual return on equity chart. It has the same shape, but it looks a little bit. So much of this move now looks a lot like EBITDA margin, doesn't it? You're really seeing that more pronounced now that they got it fixed. So the long-term trend down is kind of a combination of margins falling and then turnover falling pretty dramatically the last few years. But this seems to, you look at 15 and 12, it seems like the EBITDA margin really is dictating the shape more than anything else. All right. So let me look at what I actually, well, before I do that, let me show you other things I have on your print page too. So if you look down at 15A, I've got a few other things out there that you might want to use. One of them is the EVA spread. It's one of my favorite ratios to pull in. What the anybody remember EVA? Any takers on that one? Y'all had it in my class. Y'all remember it? The EVA is what minus what? Return on invested capital minus cost of capital. Why do you want that number to be? High or low? Or as high as possible, right? So EVA is the actual return you get minus your required return. So anything above 0 is good. That means you're making more than your stockholders require. Below 0 means you're destroying value. So the EVA is there, EVA spread. And then return, I do actually have return on invested capital. So return on invested capital takes out that leveraging effect. And it should look very, very, very similar to ATO times margin. It should be a very similar type of chart. Both of these charts will look a lot better if you take out the 10% on the Walmart one, and maybe even the 90%. So the reason I show you that is if your answer ROE is this firm's doing a great job, but then you look at EVA spread and it's negative every year, you might have to rethink your conclusion. Because maybe they're not doing that good of a job. So EVA spreads there. I'm not sure return on capital is going to tell you anything new. I don't do EVA or return on capital in the Walmart example. I do talk about the return on equity, but I do have those charts in there just in case you want to use them. EVA is one of the most predictive. If you want to look at why a stock has done really well or really poorly, go look at their EVA spread, and not probably more than anything else will tell you the story. I used to do that with Home Depot and Lowe's. You saw Home Depot just come roaring back with their stock at the same time the EVA came roaring back. Now that doesn't help you as a stock investor unless you're really good at forecasting EVA, but after the fact, the stock goes up because the EVA is going up, and it is one of the most predictive of explaining what happened. It doesn't help you unless you can forecast it somehow. All right, so let's look at Walmart. So the way this works is you have liquidity, solvency, and a summary of liquidity and solvency. Is this firm about to go under? Credit ratings is your main solution that summarize liquidity and solvency section. Then you're going to talk about asset turnover margin, see if they're profitable. You're going to summarize that by just looking at ATO times margin and bring that together. And now you're going to summarize everything all together with ROE. Well, ROE has everything but liquidity in it, right? It has solvency because you have that financial leverage. It has turnover margin, obviously. It also adds in taxes. It has liquidity indirectly because remember the strong tie between liquidity and turnover. So it's kind of in there. So this is the way to summarize the entire paper. To summarize my findings in Walmart, now turned to return on equity. The overall return on equity has been consistently above the industry until 2021. But this is due entirely to the improvement in financial leverage. The industry is deteriorating financial leverage. So you can see the industry passed up Walmart. Is it because the industry is a lot more profitable? No, the industry just levered up because of what happened with COVID. So yeah, so Walmart looks like its ROE got worse, but really they just are not as financially levered as the industry. So therefore, Walmart's lower relative position is not a serious concern. So that's the reason we do ROE decomposition. You look at this and say, wow, Walmart, they're doing so well, and boy, 2021 is a horrible year. And then you discover that this number is artificially high because of the financial leverage, the equity multiplier. So it answers that question. The other thing we look at is the asset turnover times margin, and it has been on the continuous decline until the bounce back in 2021. So Walmart's superior ROE in the first few years wasn't really all that superior because their financial leverage was much higher. However, 2021, you actually can say they've done a fairly decent job because the ATO times margin jumped back up. So you see how what DuPont is after here. Wow, this looks good, but this looks bad. What's going on? Well, because of this, leverage explains it. So you really do have to look at these charts combined. I might have made a mistake when I did the Walmart of, pulling the industry median out. You might have to leave that in there so you can get the answer a little bit better. That might tell you more to leave the industry median in there. But your goal is to somehow explain what's going on with this chart versus the industry. So for Walmart, steeply declining ROE, but financial leverage is finally back below the industry. So my final solution is, hey, 2021 is an unusual year because of COVID. It actually looks like a recovery year for them. ATO times margins back up. Their ROE is down only because their leverage has dropped dramatically after they pay off that debt. So I would actually give them a good score in 2021. I actually would say this is worrying until 2020. 2021 is like the first good year they've had in quite some time. And we know it's probably not a year. I sure hope it's not a year they're going to repeat. How many more pandemic driven years do you want in a row here? And, and can they actually improve? We'll just keep buying stuff from them, but can they even get better? So eventually people are going to stop doing pandemic buying. So, so the next year is another, wave of COVID. So I don't know how long until we're going to see this be normal again. So we do have that problem that we have 2020 was a fairly unusual year. So where would I focus? Turnover is an issue. So you have some final thing of what's your major concern with your firm. Just go back. So my biggest chart is the ATO times margin. What's going on there? I wish I had taken out the industry. There's some. I think it would have been a little bit easier chart to do if I'd done that. Here's another chart where you might do it twice. Do it once with the 90th and 10, and then do it once without. Should we change the format here? I don't get too crazy. Is that too much? Maybe a little much. Use your judgment here. But the industry is on a huge decline. Walmart is on a huge decline, and then COVID-19. So have they really turned themselves around? Are they now on the way back? Or was COVID just a one-time thing and we'll see them coming back again? All right. So if you think about this particular analysis, I want to actually show a chart. I show one of my other classes because I think it will help you. No, that's last year. Got too many files. Okay, I'll show you all that. Okay, let me just bottom line. So if we look at the rubric, well, let's see how much of this you remember. So you got solvency first. What were the three things you're going to look at on solvency? CFO growth, net working capital net working capital requirement, and free cash flow evidence, dividends, stock buybacks, debt, capex, acquisition. All right, so you got those three things, and then we got, I'm sorry, no wonder y'all looking at me. Liquidity, and then solvency. What are the three things you can do in solvency? Times interest earned, debt, EBITDA, and growth in debt. And then you're going to summarize the short term. You can look at credit ratings, quality of earnings. All right, then you have turnover. You've got growth and revenue. You've got turnover versus capacity growth. Y'all remember that one? Then you have just good old asset turnover. Then you have margins. Anybody remember on margins what we did? Gross, net, and then we look at the growth in earnings versus growth in revenue. We're looking for operating leverage. And we're going to do summary of the long term, and then we focus on ATO margin. And then we have overall summary. And there we look at ROE, and we break it out between ATO margin versus financial leverage. Until I got some extra letters in the margin. All right, so there's your entire paper 3. So there's some things that are really, really simple. CFO growth is really simple. The solvency ones are really, really simple. Growth and revenue, really simple. Asset turnover, really simple. I mean, it's right, really simple. You got your firm's asset turnover, you got the industry, you're looking at the trend, higher's better. It's really simple. Almost no one gets anything but 100% on that. Gross margins, really simple. Net margins, really simple. Right, so that's a big chunk of the paper is really, really easy things. Some things are a little more challenging. The free cash flow discussion can be a little bit tough. What I don't like in the summary of the short term is students don't tell me anything. I get to the short term summary and it's almost word for word for what I typed for Walmart. It's like, I seriously doubt your firm. So go back. What do you do for the short term summary? You go back and see what you said. You said 18, you said 8 things, 9 things. What were the 2 most important ones and bring that back into your summary? All right, so tell me something there. Same thing with ATO times margin. It's fairly simple. Up higher is lower, or higher is better, lower is worse. But tell me something. Go back and look at your asset turnover. Go back and look at your margins. See what's going on. and don't repeat it, but find a way to summarize it in a powerful way. All right, and then some things are just really, really difficult for most students. I don't know what color to use. There we go. That's pretty tough. So net working capital requirement, that's a really tough one. I just graded several papers for a class on that one. And there's some students, their net working capital was a major use of cash, and they kept talking about how it was a major source of cash. And it's hard to grade something like that when they're going the exact opposite of what it says. So that was tough. The turnover versus capacity. To me, that one's really, really straightforward, but I have students that I can tell from what they're writing, it's not sinking in. So I'm obviously not teaching it very well. But when you think about it, I mean, here, I'll show you. So we have growth and revenue per store is 1%. Growth in number of stores is 3.5%. So what do you notice you have in your paper? Both of the numbers you're talking about are related to stores. All right, here's what I got from some of my students. I got revenue per employee and revenue per PP&E. What's missing? I got 2 turnovers, but why don't I have? I don't have the growth in employees. I don't have the growth in PP&E. I can't talk about, there's no capacity here, right? All I have is turnover. And they're saying, well, that's 1%, but this is 3%. So they're doing a good job. Well, how do you know what they're doing? What if the growth in employees was 8% and the growth in PP&E was 15%? They're not doing a good job, okay? So if you show revenue per employee, what else has to be in that paragraph? Growth in employees, right? If you're showing revenue per PP&E, what else has to be in that paragraph? Growth in PP&E. If you don't do that, you're making a mistake. You're leaving it out, all right? So how did this firm do? Somewhat weak turnover, 1%, at least it's positive, but most of the growth in the revenue is coming from adding more stores, all right? What about this firm? How did they do? That looks pretty decent, right? 3% in this environment is not a bad, so that's good. Now, do you want this to grow with revenue, or grow with inflation, or does it need inflation? This is revenue per store. Do you talk about inflation with this one? You would with this one, and why is that? Because stores is not a dollar amount. It's a physical thing, all right? What if we're doing revenue per PP&E? Can you say not keeping up with inflation? You can't say that there. Why can't you? Because both revenue and PP&E are in dollars, so they're both impacted by inflation. So their inflation cancels out. Everybody understand that? So with the Walmart example, I talk about them not keeping up with inflation, but there I'm using revenue per square feet. Square feet is not a dollar amount, so there's no inflation there, so they should keep up with inflation. So if you're doing revenue per PP&E, don't mention inflation at all. It doesn't matter. You just want the number above 0, and they're getting better, so that's good. All right. What about this firm? How are they doing? That looks really good to me. But I have students that say they're doing a bad job because 8's greater than 5, but that's not how you do it. 5 is a great number. In fact, if a firm is growing the revenue per store at 5%, I'm glad they're adding more stores because they're obviously doing something right. All right. So it's not, is this number better than that number? It's, do they have some good growth here? Because this is the growth we want. Because this growth is very expensive. You got to spend millions of dollars. You got to hire new managers. It's a pain, and you're maybe even cannibalizing your own business if you put too many stores down. So this is the growth we want, but it doesn't have to be higher than the growth in stores. It just needs to be a good number. Okay. And that's why I've had some students say, wow, that's great because this number is greater than that number. Well, that's a pretty pathetic number. I'm glad they're reducing their stores. But are they closing down the right stores? I mean, how bad would this number have been if they closed down those stores? So, so that's the kind of thing you got to interpret these numbers, all right? So students struggle on this one, but you got to make sure you have both numbers. You have a turnover number and a capacity number, all right? So that one's like the
like good, bad, good, like.
yeah. This one I would consider weak.
Okay.
This one looks great. That's 3% is pretty good, and I like it when firms, maybe it's a concern they're closing down stores. But if they're doing it for the right reason and they're closing down inefficient stores, that's fine. I mean, you're always concerned. So maybe we say great with concerns. I don't know if I ever want to invest in a firm that's shrinking their business. This one is what? Great, great, great. I mean, there's no reason you want the 5% to be greater than the 8%. There's no theoretical reason why you want that number higher. And this, you say it's weak and concerns.
So the reason why the first one is weak is because it doesn't go with inflation?
Right, because we're doing stores, 1% is a pretty weak number. And that's just my theory is if you're doing revenue for something that's not in dollars, you would think they at least keep up with inflation. We're just talking about revenues. Why aren't they at least raising their prices with inflation? So that somewhat bothers me. All right. This one's weaker with concerns because you're getting really horrible growth. Plus, they're shutting stores down, and it's not helping this number. It's like, what's going on with this firm? This is like a business, it's J.C. Penney or something. I don't know which is that. All right. So if you're not sure, it kind of depends on your business, and you also got to pick which number you're going to use. But this is one students certainly struggle with. And then this one, for some reason, students struggle with this one. I think the biggest problem is this number is not really going to tell you anything new from the net margin number. If the net margin's coming down, then the revenues are growing faster than the margin. So it's just in the earnings. So it's just what I like about this one is it someone tells you a story over time, and I like looking at it. But you're looking for evidence of operating leverage, of fixed costs, and if they have fixed costs, you would assume they can spread those fixed costs over more revenue so that their earnings will grow faster. So that's the kind of thing you're looking for. And then ROE is just a hard one. And it's a hard one mainly because I don't think conceptually what we just talked about is all that difficult. What I think is difficult is that there's so much noise in the accounting. So when you get to this part, you're gonna have a tough time just telling the story because you're gonna have all this mess to deal with. Right? That to me is the hardest part of this one is it's just messy. And the reason it's messy is that there are other things going on in this financial leverage than what we're saying that number is. Okay. There's other things going on with these companies that are causing these numbers to flip around. So you have this firm who's financial, some of you are going to see this. Financial leverage jumped up and debt declined. Well, taxes in there as well, but I'm just hoping that it's not an issue. I'm hoping for most of your firms, your tax numbers is a flat line, but because of 2017, what do you do here? Their financial leverage jumped up, and yet they reduced their debt. You just start making stuff up because actually going and figure that out is quite the forensic accounting task. I mean, you might want to try it, but it's tough. There's something that happened on their liabilities that has nothing to do with debt, right? Debt comes down, but financial leverage jumped up. Well, it could be because they had some other liability jump in. Could be that they bought a bunch of their stock back, and that caused their equity to come down, and that shot it up. There can be all kinds of things going on. So I'm somewhat lenient on the ROE discussion if I can at least see you gave it a good try. As I realize this is where it gets the messiest and the numbers are just a pain. That's one of the reasons I put the EVA in there. So I wouldn't mind if you get to this ROE discussion, you go, you know what? there's some accounting stuff going on with this firm. It's just really difficult to figure out. I've thrown in the towel. I'm gonna instead focus my attention on EVA. And EVA shows this firm soon. I would be fine with that. If you just like, I just can't take it. There's just no way to explain this. So, you know, that is another approach you could take. All right, so rather than panicking on this, realize you got a lot of green here that's really pretty simple to talk about. And then you've got 1, 2, 3, 4 things that are tough. Okay. What you could do is write everything as best as you can, and then sit down with me on those 4 things. Let's say, let's just see if you got it. All right, let's see if it makes sense, and I'll help you in those pieces. Now, if you're having trouble with every single one of them, I can't help you with that, because this should be a 3013 review class. All right, so you should have had all of this before. But yeah, I mean, I can't help you with all of those. And some of them, you know, I didn't give you everything you could do in that. You know, I kind of summarized it and shortened it down, which means there may be things going on there that you purely can't explain because there's just too many other things going on. All right, so that is paper 3. I think I stopped it there. I can't remember. Yeah. So some of the examples you'll see in some of my classes, I do a relative value analysis after this, but don't do that in your paper. If I see that, I will count off, because that's not what this paper is for. You're doing paper 7, which is going to do that. All right. So there's no reason to do that here. So if you do that, I'll know that you weren't paying attention right now. So, all right. So that is paper 3. Paper 3 is the most straightforward because I've already written it for you. You just got to edit it for your company and bring in your charts. So if I were doing this, I would load Walmart. I'd probably get rid of this thing because that doesn't make sense in the scheme of your papers. So I would take this. I'd probably take out that big F. I would just copy and paste this into my paper. And then I would go in and get my charts without them being edited. I'd get my charts and just plug them in. Write the paper and then go back, edit the charts, change the titles, and then recopy the charts in. That's how I would do it. I'm not saying that's how you have to do it. It's hard to write your paper if the chart's not in the paper. You know, flipping back and forth between the charts. So I would bring it in. You might have to go a couple of times back and forth because you might find a chart where you want to take out, you know, take out one of the numbers and see what it looks like. So, you know, you can certainly go back and forth on that.
What did you say we could possibly use the one with the margin line on the industry? One with the median.
Well, when I did, I think you're talking about when I brought these over to do the ROE, I probably should have left the industry median in there. So I could somewhat explain not just how Walmart did, but how Walmart did versus the industry. So if I'd gone back and left industry median in all of these, that probably would have been a bit better chart. For the ROE decomposition, or is, oh well, on that one I think I was saying I should have taken the 90th, and where is that chart? Yeah, oh, I think I did take it out of here, right? So the one that I had on the paper had the 90th and 10th, and I probably should have taken it out because this tells me a whole lot more. The other one, it looked almost like a straight line, but when you look at it like this, it's Walmart's a lot more volatile. I mean, there's no doubt Walmart has been coming down, but when you saw what I showed before, you just couldn't see it. Kind of looked like a flat line. It's in there. I don't know what happened to it. Did I changed my so it looks like just a flat line. Was not a flat line, is it? It's a fairly good decline. So the other thing to think is, let me put this chart in there, and then I'm gonna do chart 14A and 14B, and 14B, I'll just do it without the 10 and 90th percentile and show the chart again. And just explain, I took the outliers out just so I could show you how Walmart looked versus the industry, and show how much that decline was. So yeah, that's fine. Use your judgment. I like having the 90th and 10% in there. First of all, to see if my firm is actually at the 90th or 10 percentile. And also I'm just curious, one thing you're trying to build is rules of thumb. So if you're in an interview with one of these firms, when should you gasp at a number? Well, if you're outside that 80th percentile, that's probably a pretty great number or a horrible number. Without that range, it's hard to know what's a good or what's a bad number. I always like having the industry median in there. Even if my firm's way off from it, I want to know what the typical company looks like. All right, so ignore these. I meant to take these charts out of yours. I may have taken these out of yours. All right, so that's paper 3. So it is generally the most straightforward one. Someone in here doing Salesforce? I can't remember. They just did a business breakdown on Salesforce, the podcast. It was really good. I didn't know Salesforce that well, but now I'm like really impressed with the company. So yeah, if you can listen to that podcast, I think it would give you some good things to add to your paper too. One thing in particular on Salesforce, you got to write about management. That podcast did a great job of talking about their founder CEO. They still have their founder CEO, right? That person's still there. Just his Hawaiian philosophy, which I thought was a little bizarre, but it's Hawaiian philosophy. But interesting. Some guy coming from Oracle and it's going to change the world. And it's a pretty amazing story, right? Salesforce just came out of nowhere, and now it's this massive $200 billion firm. So anyway, all right. Can we leave paper 3? I feel like I can do it. I'm curious. What was it, before we did this? Someone came up to you and said, "Do a financial analysis of the class." How would you have tackled it? How many of y'all the first thing you would have done was a current ratio? That's been my experience with most finance majors. Y'all feel comfortable doing financial analysis? This is a huge part of your career, right? This is what you got to do. So y'all did this exact same thing in my class. You feel comfortable with it. So I found a lot of finance students, it's like you give them a company with financials and it's like they don't know what to do. They don't know where to start. Let this sink in. This is one template that I think is a fairly decent template. I know in your capstone classes, you do like case studies. I don't like case studies because you know how case studies, everything's so nice and pretty and clean. There's no numbers flipping off the chart like that. That's not the real life. The real life is messy accounting. And these hard business cases, boy, they make the world look so easy. These Harvard MBAs must come out thinking everything's just nice, straight lines, and you just walk in, everything's perfect, but that's not the way companies are. So it is frustrating. You can see I get frustrated with Walmart. It is frustrating, but I want you to sense some of that frustration because it's the real world, it's what you're dealing with. And when I grade your paper, I take that in consideration. You've got firms with messy accounting. Yes, you just have to deal with it. And so I take that in consideration. I'm looking more that you're going through, thinking through it, doing the best you can to try to figure out what's going on. And then we'll go from there. All right, I'm going to click out of that. Go along Walmart. And this is a template. If your first job, they tell you to do something like this template. If you don't know what to do, use this template. Just go with it. I've had students around the globe ask for this template. I have no idea who they are. Some of them are PhD students, and then they'll email me again, and they want me to go pull all this data from them, part of them from Bloomberg. And they're like, yeah, Bloomberg would have a fit if they knew I was getting their data and sending it out to the world. So yeah, I can't do that. And 4 PhD students that are so desperate for data. All right, y'all got all that, but this is the same thing as in the Walmart example. All right. A few other things that you can do with financial analysis that we're not really doing in this class. The first one is this concept of sustainable growth. And what sustainable growth means is how fast can this company grow without having to borrow money or issue stock. So it's the ability to grow without outside resources. The traditional approach to sustainable growth is return on equity times your retention. That's the way I always taught. That's been around for some time. So you take the firm's return on equity and retention, which is how much of their net income they keep and don't pay out in dividends. That's the fastest you can grow without having to need outside research. There's a major flaw with that ratio. We just saw ROE. What's in ROE? Well, there's more than just financial leverage, right? There's asset turnover and margin. What does this sustainable growth assume? It assumes asset turnover and margin are constant over time, that they never change. Is that true for any company? It changes all the time, right? So as your asset turnover and margin go up and down, your growth, sustainable growth go up and down. So this number assumes you look at a company in any given year, you get 9%, and that's their sustainable growth. Well, next year their turnover and margin changes. So it's a moving target. So it's not quite so precise. The other thing it implies is that the higher the payout ratio, what does that imply for growth? So if you pay out more, what should your growth rate be? Should be lower, right? Because the growth rate is your retention. If you retain zero, if you pay out 100% of your income, how fast can you grow? It should be 0%, right? Because your retention is zero. If you retain everything and your ROE is 10%, how fast should you grow? Grow 10%. So what does that imply? That implies higher payout, lower growth, right? So firms that pay out more of their earnings should be growing more slowly than firms that pay out less of their earnings. What does empirical studies show? Higher payout equals what? Higher. So does that support the theory or not? It destroys it. So good old Robert Arnott, he has a chart, he shows it, and the chart goes the exact opposite direction, and it's incredibly predictive. Does that mean the theory's wrong? I don't think the theory's wrong. It's not a theory. Issue is management behavior in crisis. So 2008, retention rates shot up in 2008. Does that mean earnings growth shot up in 2008? What happened in 2008 earnings growth? It knows that. Why did retention rates shoot up in 2008? Because management was scared to death and they didn't pay dividends. And then you come out of 2008 and suddenly firms start paying dividends a whole lot more. Is that because their earnings growth is falling? No. Why were they paying out more dividends? Because their earnings were growing and they were confident in their paying out. So you got this timing issue that managements pay higher dividends when they're confident and they're growing fast, and they retain more, not because they have all these great growth opportunities that are going to reinvest in the firm. They're retaining because they're scared to death. So you have that dichotomy, that thing going on that's just destroying this theory. So I think the theory is correct. Firms that have high growth, have great opportunities, they should retain more, reinvest in the firm, grow faster. Firms that are cash cows, they don't have any growth stories, they should be paying out a lot in cash. And that should support the theory. But in practice, managements have a lot of other things going on that kind of distorts that. So I think the theory is correct, but the empirical data is somewhat distorted because of these, year to year managements making decisions for other purposes. So you can use the ROE from DuPont to try to figure out the sustainable growth. What is their normal asset turnover, their normal margins? Look at that over time, and that gives you a sense of how fast they can grow without needing outside help. So if they're growing too fast, what do they do? They can retain more. They can change their capital structure to, try to get some kind of optimal mix. But the main thing they can do is improve their operating cycle, get better turnover, get better margins. Ultimately, if you can't handle it, you cut back on growth, and firms do that. We did that at USAA. USAA opened up to the enlisted market. They're gonna do all 50 states really fast. And then they had to cut back really fast. They couldn't keep, it was just too much. And so they had to cut back. Sometimes you just have to stop because the growth is just too much. You can't fund it. All right, something else you could do. This is probably more going to help you, and we'll talk about this a little bit. For paper 4, common size financial statements are really helpful when you need to do forecasting. So a common size balance sheet, do everything as a percentage of what? Assets. And what are you looking for? You're looking to see if there's some line item that's getting out of whack from the others. It's receivables used to be 1%, now they're 4%. Inventories used to be 40%, now they're 23%, you know, those kind of things. You're trying to see if there's something strange going on. The income statement, net income, everything on income statement percentage of what? Revenues, right? You're trying to see, wow, look at the marketing budget. It used to be 7%, now it's 13%. So watch that over time. In fact, Beatrice, I just saw an article on Facebook that Cisco is hiring a bunch of people for sales positions. Well, that's kind of interesting to me. What's their SG&A doing? You know, as he hired these. So that's the thing with Salesforce. Salesforce says they're willing to spend $1 in sales costs to get $1 in revenue. Why in the world would you do that? That sounds like a terrible business. But what does Salesforce have going for them? That $1 revenue is going to do what? It's going to stick around for 10 or 15, 20 years. So they'll essentially lose that first year. They'll spend $1 revenue and sales expenses to get $1 in revenue. They're going to lose money, but they're going to keep that customer for 10 to 15 years. That's an interesting model. What does that imply for looking at the ratios? Well, this year might look bad because they're setting up a great next year because they got a lot of sales this year. So anyway, so you'll see those things in a common size financials. Damodaran, he says, is management's doing the right thing to increase firm value? Are they increasing cash flow from existing assets? How do you do that? Reduce your costs, higher margins, divest negative businesses, reduce your tax rate, get more out of your previous capital expenditures, doing better with working capital. Is the management reinvesting only in those projects that have positive EVAs? Are they increasing the margins, increasing turnover? Are they doing good acquisitions? So I like this last part that he talked about, is where does management add its most value? The top 3 markets. Now, I don't know if Damodaran does these studies. They're always intriguing. They're always really interesting, but I don't know if anyone scrutinizes his numbers. So he's a smart guy and I trust him. So I'm going to say, okay, this is probably true, but I don't know. I haven't come back and tested his number. But you add a new product, you expand an existing product. So you have a product, and you find some new use for it, or you maintain or expand market share in a growing market. These successful is acquisitions are competing for market share in a stable market. So if management's doing it, you know, this is where management has the most likely, highest probability for success. This is where they have the least likely success. So Salesforce is now doing major mergers and acquisitions, major acquisitions. That's a little bit of a red flag because that's an expensive way to run a business. But can they maintain high growth for a longer period? You know, create an economic moat, brand name, legal protection, those kind of things we talked about before. Can they reduce their cost of capital? We won't get into this much, but you can increase the value of the firm by reducing the cost of capital. If you can do that without destroying free cash flow, that is like an easy way to increase the value of the firm. So what is your management doing to increase the value of the firm, and is it showing up in the numbers? That's Damodaran. So this comes from my first boss in finance. There's 2 ways to increase the value of the firm: increase free cash flow or reduce risk. Management can do either one of those. I know with Valero, when they sold off the Cornerstone stores or whatever, the convenience stores, part of the argument was to reduce risk, because their argument was our cost of capital is too high because our business is too complicated. It's really hard to look at a refiner and a retail business together. let's get rid of the retail business. They'll get their own cost of capital. We'll get our own cost of capital. It would be the separate will have actually lower combined cost of capital than the firms combined. So the value of both will go up. That was their argument. Whether that worked or not, that's an interesting approach. All right, so we got to get into paper 4. All right, let me just tell you bottom line on paper 4. If you look at the rubric, it's 50% sales forecast. So that's where we have to spend our time. So we're going to spend some time on sales forecast. And I'm going to give you 3 approaches. I'm going to give you some examples from previous students in the 3 approaches. So the first one is find your turnover ratio, forecast, the denominator, forecast, the growth in the turnover, multiply the revenue. So a good example is for Walmart, I'm going to do revenue per square feet. So I'm going to forecast square feet. How much is Walmart going to grow their stores? I'm going to forecast, I don't know why forecast is misspelled, a growth rate for revenue per square feet. What might that number be for Walmart? So how do you get growth in revenue per square feet? It's traffic times revenue growth, price increases. How much extra traffic is Walmart getting in existing stores? Do y'all see anything that's causing people to suddenly run to Walmart? So anything they're doing that's having a material impact there. What kind of price increases do you expect? This might all end up being what? Inflation, right? That might be that simple, unless I can think of some reason why they're suddenly going to do that. And here I might look at management in my the class I'm doing for the investment society. We're forecasting Costco. Costco adds about 25 stores a year, so I'll probably do revenue per store, and I'll just keep adding 25 stores for a while, and I'll let that be my forecast. And when you multiply those 2 together, you're going to have, your revenue per square foot. You're going to grow that with inflation. You're going to grow your square feet. You multiply those 2, you get your revenue forecast. Okay, I'll give you the other 2 approaches next class. Okay, so your paper 2. Is anyone doing Deere? I don't think we had anybody doing Deere. Breakdown is a really, really good one. Yeah, this business breakdown, boy, they just take capstone and have you write papers on business breakdown. It's better than most management classes I've seen in capstone class. I mean, it's just it's real world stuff. Yeah, they had a really good presentation on Deere. All right, so you ready? Oh, lo siento. I don't know how stuff works around here. It's got to turn on. All right, so you got paper 2. Thinking about paper 2, that's made me think of business breakdowns, because they essentially are giving you paper 2. That's what business breakdown is. Talking about economic moats, which they brought that up quite a bit. They talk about margins. They talk about turnover. I mean, it's everything we're doing. They don't do much on liquidity and solvency really, but it really is paper 2 and paper 3, and we're paper 2 ready to go. So paper 3, we finished that up. We had there's 5 errors I found in the spreadsheet. So if you're not sure before you start paper 3, email me your paper. But let me just write these down. So on print page 1, line 37, I had referenced the wrong cell because I'd make some changes. So that should be GS as the column. I can't remember what I had. So GS, and then you can copy that across. Line 41 in column D, I accidentally you got changed to line 53, it should be line 55. The HD is correct. So you'll notice it on this one because it's referencing the year. Say, wow, my revenue per store went from 2005 to 2006 to 2007, real steady growth there, but no, those are the years. All right. Y'all got those two?
If you go back to the revenue per employee one.
Yeah, and that one you'll really notice. So get kind of in your mind what our revenue per employee should be. It's somewhere in the $200 to $1 million range. The exception might be, you know, actually calculate Facebook's revenue per employee. It would be off the charts, but most companies, you know, Disney's really low because of all the seasonal workers. Firm like Facebook, they have so few employees and massive revenue. Yeah, it can be off the charts. But if you see a revenue per employee of $20,000, there's something wrong. If it's 20 million, there's something wrong. And that's why I say just think 500,000. All right. That way, if you see a number and it's 463, you know it's rounded to thousands and it's 463,000. All right. Just get used to what a normal number is. All right. Revenue per store, obviously that's in millions. All right.
So for that one, we're changing,
On this one, the first is right, but the other ones I accidentally had 53. And so it looked like that. If you see something that looks like years, then you obviously have, you know, there's something going wrong. And also remember, if you're missing a number in here and you don't know how to fix it, you know, send it to me and I'll fix it and I'll give you a number. I really wish Walmart would get better numbers on numbering. So that's the second thing. The third thing is under data for graphs, line 103. I don't know why I did that. You know, I think that error has been there for years and I've always assumed that I pulled ROE from two different places, but what you want to do there is just make that print page 1, cell 51 and copy that across. That way the ROE in your decomposition is the exact same ROE as in the chart. That way, when you're trying to explain the shape of it, you're at least looking at the same numbers. All right, so that's the third thing. Everybody's got that on the data for graph building. And data for graph building is the place you go if you got a number that's off the chart. Go find it and just delete that cell. Don't delete rows. Don't do Control X. So, but you can definitely just go up to a cell, hit your delete key. I see students do this to delete, and boy, that just really bugs me. You don't need to do that. Just hit the delete key and it's gone. All right. All right, and then the last two are on the graph page. One is on chart 18 on the graph page. I accidentally did EBT to net income. That doesn't make any sense. Okay. It's net income to EBIT. So the smaller number needs to be on top, bigger number on bottom. I just somehow flipped those two. Not that you may not show the tax chart. For Walmart, it somewhat helps explain a little bit of that bounce at the end. All right, that's the very last chart, 18, a chart you might not even show. And then the other one is just numbering, but this goes all the way throughout. For some reason, on chart 6, it still said chart 6A. That's because I used to do these charts where I did it Walmart versus Costco, and then I did it Walmart versus the industry. I've taken out the two company thing, but I just forgot to change that from 6A to 6. But that is, make sure the number in your chart makes sense, all right? Don't have a 6A if you don't have a 6B. Don't have a chart 6, then chart 8, and then chart 9. So look through, make sure the numbering all makes sense as you go. You can't have a 6A and 6B if you want to show, like here it is just with the median, here it is with the 90th and the 10%. That makes sense to do A and B. All right, so that's 5 errors. That's not too bad, given how much radical change I made. Although I think 2 of them were there for the last 10 years anyway. So, all right. If you're not sure, email me your Excel and I'll look through it real quickly. You don't want to be writing this up with the wrong numbers. I'm sure there's another error in here. It's a pretty massive spreadsheet, so I'm sure there's something else in there. But that's the nature of finance. I still remember meetings where we're walking in to talk to the CEO and I find the error. So that's always fun. All right, let me real quick. Devin, Jabari, Alex. Okay, so you have to submit notes then. Tariq, Marcus, Savannah. Victor. The other Anthony probably got credit for being here because Anthony's here. So, okay, Victor, Fernando, Armando, Raul, Patrick, Sanji, Harley, Alejandra, Nick, Alex. Oh, there. Oh, we got a bunch of Alexes in here. Mauricio, Beatrice, Crystal, Edward, Alejandro. Oh, Mauricio. Sorry, I didn't see those. Sorry, man. You know, I'm using your intern for all of the videos for the Investment Society. I don't know if you noticed, you have like 4,000 Zooms on your internship. Yeah. So if you go on to your intern, you're going to be like really surprised. Alejandro. Oh, so you go by Alex too. Then. Okay. Oh, you're Alex. Oh, Alejandro. Okay, sorry. All the Alexes and all the Anthony's are here. Oscar. I don't think there's some. Did I miss anybody? I don't think. Okay. All right, so let's talk about forecasting. I am teaching this forecasting class and I'm putting those videos out there. It's a little bit more than what I'm asking for in this class, but I don't know if y'all are here, those that were here last night with Arsene, he talked about financial modeling and how critically important that is. And so, it's important that you be able to do a forecast. And so what we talked last class is we're doing forecasts. What's the most important thing? Revenue. If your revenue forecast is bad, it doesn't really matter what you do with the rest of the forecast. Just make up numbers. It doesn't really matter. So forecasting revenue, and I said there's 3 approaches I've seen, and then some are combined. So one is the turnover ratio approach. We'll look over that. We'll talk about the segment approach and the factor approach, and then combinations. You can do the turnover approach with the segments. You can do factors by segment. It's hard to do factors and turnover combined. But all right, so the turnover approach. What we're going to do here is in paper 3, there's a turnover ratio you really focus in on. Maybe it's revenue per store, revenue per square foot, revenue per employee. What you're going to do is you're going to first forecast the denominator. So what I'm going to do with Walmart is I'm going to forecast square feet. Figure out how many square feet they're going to add. Then I'm going to give a growth rate to the turnover ratio. So that's again where you got to make sure, do you adjust it for inflation or not? So if you're doing revenue for PP&E, there's no inflation rate. You may just have a 0 as your growth factor. So as property plant equipment grows, your revenues grow just very much in lock. But since I'm doing revenue per square feet is not $1, so I need to put an inflation in there. So I'm going to put some growth rate in there. You might look at history, and then we just multiply to get the forecast. This is probably the simplest approach. That's why I brought up Cisco Foods. Is they're hiring all these new sales reps. Yeah, you can definitely say, how much revenue are you going to get if they add 100 more sales reps or 200 more sales reps? And with Salesforce, $1 and SG&A is going to give us $1 in revenue. Well, then you can just forecast SG&A and you somewhat have the new revenue coming in. All right, so I'll show you that approach. So let me show you what we did with Costco in my class. So I'd recommend you have one Excel sheet just for revenue, just so it's 50% of paper 4 is revenue forecast. So I would focus your attention on that. Essentially, paper 4 it's an easy paper. Once you get the revenue done, you're not really writing paper 4. What you're doing in paper 4 is you're just explaining what you did in your forecast. So paper 4 is an Excel exercise. You build it in Excel and then you explain it in the paper. So it's the easiest paper to write once you got the Excel done. You just go through it. So you need to explain your process on revenues. And then the rest of it is, I'll show you as we go through it. You say, well, their gross margin has been 32%. It was as low as this or high as that, but the last few years it's been this, so I use this. You know, it's just your logic for what you came up with. Okay. So what we did with Costco, and y'all tell me if something goes wrong with the screen. My investment class today, they're like completely disappeared, and they let me talk for like 6 minutes. So you can see here, you can see here, Professor, we don't see anything. Oh, okay. So you told me like 2 weeks ago. All right. So I have, since I'm going to use revenue per store stores and revenue per store, I need to bring in stores. Well, Capital IQ gives me stores. So that's kind of nice. Now in the class, I just wanted to show them, they can get a lot more complicated. So what we did is we looked at number of stores per million Americans. We looked at it in the United States, we looked at it in Canada, we looked at it in the UK. We looked at it in China. They have what, 1 store in China? So that was like, you know, point whatever. And then we started thinking, you know, what would be the ultimate? If they were everywhere in the world they could possibly be, what would that be? Are they going to be as saturated in Europe as they are in the United States? You know, you start thinking about it. And then how long is it going to take them to get there? And what is the population growth? We're not going to actually do that in the class. This last time we just, you know, I just threw in a number. But that's what you're really going to do. If you're doing Facebook, you're going to go around the world and see where are they, how saturated could they get. So here's the number of stores. And there's the change in stores. And you can see over time, they've averaged 23 stores per year. I've always heard their goal is to add 25 stores a year. So that seems pretty consistent with that number. So that seems, it's a little lumpy, but it might be lumpy just because do they count 25 by how many they start, or is it 25 by how many they open? You know, exactly what is the counting? But there aren't too many years that are really radically off from that. Here, you got 3 years that look really radically different, but it averages 27. So even then, it's not that big of a difference. So I guess what I'm going to do, how simple can you get? There's my forecast. What did I do? Added 25 stores every year. That's pretty easy, right? Would it be nice if I had a nice quote from the CEO of the firm confirming that in some way? Yeah, that'd be pretty strong. It help solidify that. And then I also did revenue per store. And here, if you look at the average of this over time, that average has been 4.6%. Well, that's a really good growth. That's a lot more than inflation. Does any number stand out in this history? COVID-19, right? So I might do it without that, and that takes it down to 4%. 4% is pretty strong. They're doing things to try to get more growth. What did I use? I used 2%. So those doing Costco, you're going to have to talk about it a lot more than that, because I'm not, you know, I'm not actually forecasting Costco. I'm going through the process of forecasting Costco. You got to come with these numbers. All right, sorry. Given that I just turned that on, that seems kind of strange. So, right, well, questions on that. So I forecast the denominator, the 25 stores a year, forecast the ratio, revenue per store. I'm going to add inflation on that. The third thing we did in the class is we went to Bloomberg and saw what Bloomberg was forecasting. You have to change it to annual. And what did we discover? Boy, the analysts are quite optimistic. Our forecast was way below. And we actually graphed it, and I do recommend if I could show you one of these days. Hopefully the people on Zoom, are the people on Zoom still with me? Hopefully. I think, yeah, you can actually see what I'm doing. So everybody look at William's machine. But so we actually looked to change it to annual, and I always graph. Whenever I do these numbers, I like to do the long-term graph. the last thing you want to do, I've done it many times in my career, but you walk into your boss's office and there's this massive jump somewhere in the numbers, and your boss says, well, what caused that? And you have no clue. The most obvious question of all, you look at the graph, that's the obvious first thing they're going to ask, and you never thought about it. And why is it? Because you're so into the weeds. You come back and, oh, it jumped 50% in 1 year. Yeah, I don't know why that happened. It's like, well, okay, that would be kind of important to answer that. So I always graph. I'll show you here pretty soon if it ever starts back up again. So when you look at my graph, there's a bump for COVID-19. That makes perfect sense to me. I don't think COVID-19 is like people suddenly went to Costco and they're going to continue doing that forever. COVID-19 permanently changed them. They used to eat out at Jason's Deli. Now they're going to be buying all the meals at Costco. I don't think that's true. So I had to come back down, and I did my long-term growth without that. So you see the bump and the bump back down. Maybe I should have gone 2 years with COVID and then come back down, but you know, that's the way I did it. So, okay, come back down. So anytime I do a forecast, as I go, I do quick graphs. So here's my revenue forecast. Does that look outlandish? Now, what's the first question your boss is going to ask? What is that? All right, so, but you have an answer. It's COVID-19. It makes sense. Yeah, I mean, how many times I've been, I remember with the CEO once, he's like, there's no way that number's right. I was like, no, I'm sure it's right. And boy, as soon as I got back and talked to the forecasting team, it's like, oh, we had an error in that spreadsheet. So yeah, it just doesn't make sense. So that looks pretty reasonable to me. I'm putting them back on where they were before. This is a firm that's done extremely well. Take a firm, I mean, these are not like mediocre numbers and suddenly they figured it out. These are incredibly good numbers. And then COVID-19 happened. They assume that COVID-19 happened and then they're going to be going from there. That doesn't seem right. But you look at the Bloomberg forecast and you can't even, this is hardly even a bump. Okay, that seems a little radical to me. So, but you can compare it, and that I'm not saying you should be worried if you're a lot different than Bloomberg, but you should at least see what other people think, because obviously they've done more work on it. Now, when you do the actual charts, and I'll show you when we do Walmart, what I usually do is I do history in one color and the forecast in another color, just so it stands out. So you'll see that's already set up in the Walmart spreadsheet for you. All right, so that seems reasonable. You can do the same thing with stores. Oh, there's the graph right there. Did it twice, or maybe that's the one I just did. I don't know. You can do the same thing with revenue per store. Again, you see Costco jump in. I mean, not Costco. You see COVID jump in there. But I like to do that mainly because you see a forecast. There are people who do a forecast like that, but is that reasonable? Where's COVID-19 in there? Man, it doesn't even show up. You know, it's like COVID-19 happened and suddenly the whole world just started running to Costco as fast as they could. So that's why I like doing graphs, because there's sometimes we do something that is just wrong. We might have just we meant to key 2%, we actually keyed 20%. And you get so into the weeds, you forget to go and check the number and see. All right, so I got a forecast. So what am I going to do with that? Now I'm going to forecast my income statement. So pretty easy. I just bring that revenue over from the revenue forecast. All right. I like to go back as far in history as I can. I went back to 98 here because that's as far back as we had stores. We didn't have a number of stores. I could take this further back because I do have more years. I just wouldn't have the stores. So I could have, but I like to have a good long history. Most forecasts are extrapolations of the past. It's rare you're going to see a forecast that jumps up or down. It's just rare. So if you do that, that's fine. Just make sure you have a really good explanation for why that's the case. Listening to the John Deere, I think a John Deere, is a bunch of farmers. It's a pretty loyal, brand loyal customer group. Pretty old school, but the software on Deere tractors, They talk about IoT. You know what IoT is? Not for deer. What is it for deer? Internet of tractors. That's their IoT. They have so much software in their tractors, and it's just amazing what they're doing. Deer's been around for 200 years. That by itself is pretty impressive. But I mean, you just see that, and as you listen to them, it's like, could there be some massive change in the growth in their revenue? Probably not, because they're an oligopoly and they're just there. They're pretty saturated. But it's an interesting firm to think about. But looking at that long-term history, yeah, it just shows you the impact of what they've been doing here the last 5 years. All right, so there's my revenue. So what's the next thing I do? So then I bring in the cost of goods sold. I just bring in the history. I get a gross margin, and then I do the gross margin percentage. So as Costco is the easiest firm to forecast of any firm, there's their gross margins. Now we'll look at Tesla. Tesla's gross margins are like negative 200,000%, 40,000%. You know, it's all over the place. This is a very easy firm to forecast. What would y'all forecast for this firm? 12, 12 and a half, maybe 13. I use 13. And again, guess what I'm going to do? Put a graph. You can definitely look at the average. You can look at a rolling average. There's my graph. Seems reasonable. I could probably go as high as 13. Well, I'll probably want to go 13 and a half. I could probably go as low as 12 and a half, but somewhere between 12 and a half. It does look like it's coming up. Is that because they're selling more high-end items? Is because of their we talked about the membership fee. They raise their membership fee about $5 every 4 or 5 years. How much impact does that have? Because that's probably 100% gross margin. There's probably very, very little expense to that. But it doesn't look unreasonable, right? If I put something like that, you know, can you imagine walking in and talk to your boss? Hey, here's my forecast for Costco. Well, wait, what is this? Oh, you know, I think it's right. Wait, why are you assuming Costco's margins would change that much? So that's pretty straightforward. We do rely quite a bit on history. We could look at that average. The problem with looking at the average is it does look like something has changed in the last few years. So it seems to me the average would understate it somewhat, but you could look at the average. If it's somewhat jig-jagging around, then maybe the average, you kind of cut the middle. What do you do next? Well, the next thing we looked at, there's a lot of things on this income statement. So the question was, do we need to include costs like this? Do we need to include costs like this? And our answer was they're immaterial. They're really small. Based on their total costs, you can just sum across. I don't even remember where that one was. Do you need to include those other ones? Probably not, right? They're not that material. 99% is in that SG&A. So just lump them all together. Why would you break this out? Well, if it's material, break it out. However, I would say even if, let's say this was 4% or 5%, even if it's material, if you don't have a basis for forecasting it differently from the other line, then don't break it out. We were talking about that in my class, right? Accountants think the more lines, the more detail, the better to forecast. I don't think there's any evidence. If you don't know anything more about this line and then this line, you're going to do this line as percentage of revenue, and you're going to do this line as a percentage of revenue. And why break them out? Right? Just lump them together and be done with it. It doesn't give you any new insights or anything. So we just lump them all together into one big line. And then we looked at SG&A to revenue, and then, you know, just look at it and see, is it predictable? It looked a lot like their gross margin. So that's the number we use. We could probably go somewhere, it's going to be somewhere between 9.5% and 10%. It's not a radical number, but we're not going to use 11%. We're not going to use 8%. So it's pretty easy to forecast. So I use 9.5. That maybe seems a little bit low, but it seems reasonable. The last thing I did is, since I did all of that, I just want to make sure I got it right. So I went back and just made sure I got the right number. You know, you want to make sure you're not missing something. Oops, I got the wrong number there. Where is it? Am I in the right year? Well, it balanced when we did this in class. So there it is.
For some reason, you want to do a moving average. Moving up to justify why.
You have to give you a reason for doing it, but there are no rules in forecasting. They don't exist. When you're talking about the future, no one knows. But this is how you forecast the future, but no one knows the answer to that.
What would be? Like a 3-year-old?
Well, if it's really volatile, so like you're doing a firm that's really sensitive to commodity prices and those kind of things, so yeah, if you want to show that, it's not going to show you much with Costco's because they're just so predictable. What you're trying to do is figure out, is there a trend? So with Costco, it looks like it's improving over time. I'm not going to just keep it improving forever and ever and ever. If it's volatile, then what you're trying to do is say, okay, it's been up and down, up and down, up and down. Now we're up here. I think it's can come down below and come back to the average or just split in the middle. So, you know, use your judgment. There really is no way to predict the future other than just come up with your own basis. What do we tend to do? We tend to extrapolate the past, but there's many ways to extrapolate the past. You know, you can see why I use graphs, right? The graphs to me are pretty eye-opening. But I do go through and make sure I have all the right numbers, that I didn't miss something. Okay. The next line we do is interest expense. Well, in the Walmart model already built that you can use for your paper 4, interest expense creates a huge circular formula because to get interest expense, you need debt to equity. To get debt to equity, you need net income. To get net income, you need interest expense. So what I do, and I cheat, is I do my interest expense as a percentage of prior year ending debt rather than this year. So if your debt's pretty stable, that works really well. If your debt's pretty volatile, you might have to do some manual adjustments on the interest expense. And then I'll bring it down based on what I think interest rates are doing, that kind of thing. So my interest expense is not in my numbers yet. So then I have other expenses. Here's my operating income. Again, you can graph it just like always. That looks reasonable to me, right? There's nothing too radical there. It's very, very much lower than what Bloomberg was forecasting. I mean, I forget what the numbers were, but it was a much, we could go out to 2025 and I forget how much I don't know if you remember one, but it was very, very different. Yeah, it's like, wow, they're very optimistic on this firm.
They're kind of expecting the whole world dumping sand or Costco.
Yeah, but then we looked at the Walmart forecasts and it was pretty aggressive. It wasn't as aggressive as Costco's, but all right. And then what we decided on other is over time, it's summed to 36, which is a rounding, just a rounding here. So guess what we forecast there? Forecast 0. Now, when I did the Facebook forecast last year, it was immaterial, and then massive number. And then, so what did we do? We just assumed 0 after that. But that massive number, we had to go look at that. They had some subsidiary transaction that happened. All right, so I can't finish up the rest of Costco. You can see where we're going. Get that revenue forecast. See how easy it is to get the rest of the income statement. It's just not that difficult to do. Questions on the Costco one? We haven't finished it yet. What we're going to do is we're going to finish up the income statement. We're then going to build a balance sheet, which is going to be closely tied to the income statement. And then we're going to do what's going to be the most painful, but to me the most fun, is using income statement and balance sheet to get us the cash flow statement. And you just got to go line by line by line in the balance sheet, and then make sure you're in the right direction. I remember doing that when I was in school, and I was like, well, you do it very slowly. You write the numbers down, you make sure, and then when you're off, what's the first thing you do when you're off? I remember doing this in the accounting classes. The very first thing you do, you got a difference of 260. First thing you do is divide by 2. And why is that? Because you probably added when you should have subtracted. So you divide by 2 and you go see if you can find 130. If you find 130, say, oh, I should have subtracted 130. I added 130. That's the first thing I do is divide by 2. That never works, but that's the first thing I do. I mean, it really is a process of just making sure you're very, very careful. You don't want to go fast, because you go fast, it's going to cost you a lot of hours later. Okay, so that's the first approach. Very easy approach. If you have data, the issue here is how good are you at forecasting this? So I'm going to forecast Exxon. I'm going to do it based off of oil prices. Well, I'm no better at forecasting oil prices than I am at forecasting Exxon. But yeah, okay, I'll come. But what's the nice thing about oil forecasts? There's probably people out there with an oil forecast that you can take and use their numbers, so that might help you somewhat. Some people say use the futures market. The problem with the futures market is that's really, you know, a storage cost, present value kind of thing. So this one may not be as difficult to forecast. You do have some history on that you can look at, but then you just multiply to get your forecast. All right. No questions on that? All right, the segment approach is you get segment level revenue, use the history and management strategy to determine growth rates for each segment and forecast out by segment. And by segment, it can be product level or it can be geography, depending on what you have and what makes sense for the company. And Capital IQ does a good job of giving you whatever they have. Sometimes you only have the product level. Sometimes you only have the geography. Sometimes you have both. So it just depends on the company. So we used this a lot last semester, last year. I had several students like, I don't know how to forecast. I don't really have revenue per square foot or revenue per employee or anything like that. Say, well, let's look at their products. Let's just think about it. So let's try one. I forget what I brought in here. Let's try Disney, because Disney's a pretty interesting one. So here's Disney, and here's the products we have. Let me see if I can hide this. That choose title. So you notice we don't have the history everywhere. Let's go to the 2019. So you can see the detail over changes over time. So you got to use whatever you have available. All right. So here they have the parts. But in previous years, they have it broken out by domestic, international, and consumer products. So how do you handle that? Well, you're probably just going to have to do it at the park level and create your own line, right? They have cable networks. How far back does that go? That one looks pretty good. We're missing a year there. Pretty irritating. Right? But they have this line here called media networks. So you go in and try to clean up the spreadsheet so that you can, now, media networks looks like it's several things. It's just irritating, just frustrating. And then it just goes to one line. That's not on, you know, they kept changing the way they reported it. It's just the nature of the way businesses are. They have broadcasting, studio entertainment, direct to consumer international. Is that the Disney Channel? Looks like it is, right? So which of these is going to grow the fastest? So you can look at the historical growth rate. Disney's is a little bit of a pain because it's all over the place. So I think I'm going to switch to Procter & Gamble. But there's one approach. What do you do with the elimination? I would just have it as its own line. It is a little frustrating because you have inter-segment type of business. If you go down to the bottom, you might be able to get this in a geographically. But what happened to Americas? Were there no theme parks in the United States in 2017? Did it just disappear? Where did it go? Well, that looks interesting. United States and Canada. So that's pretty easy to fix, isn't it? So you can only deal with what you have. You can tell right there. Then it was United States. I can't do that. But anyway, you just move this up here, right? So you see how you have to sit down and try to figure out. It's pretty obvious. So you got 20 billion, it goes to zero, and then another line that's suddenly 19 billion. It's pretty obvious you're going to mix and match them. So let me do this a little bit better. So I'm going to move this up here. And then I'm going to move this up here.
So, when you add the Latin America, Canada, and others to all Americans,
Well, that's what's in their numbers. They don't break it out. I don't know exactly what they're doing in Latin America. Or what do you mean? Oh, down here? Oh, I'm sorry. Yeah, maybe. When did they stop doing Latin America? Yeah, it's in Canada. Okay. All right. Thanks, David. Let's see. Equal sum. We need that, and that, right? So I double counted that one. Does that look right? 41,881. All right. Well, I don't know if it's right enough, but we'll go with it. All right. Oh, excuse me. Let's see. Right, so we've got some revenue here for the United States. So far, how far back do you go? I like to do 3-year, 5-year, 10-year. So how do you do CAGR? Y'all remember? What's a 3-year CAGR? So what is my beginning here? 1, 2, 3, 4, right? You're going to do a 3-year CAGR. You got to go back 4 years minus 1. So there's my US. There's my Europe. There's my Asia. 5-year, same thing, right? Except for I go back to what? S, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So 10 years will be column N. Let's look right. Column N. My 10-year. Oh, wow, I did something wrong there. Oh, wait, what did I do wrong? Sorry, guys. We want a CAGR. Sorry. 1 divided by 3. 1 raised to the 1 divided by 5. Why didn't y'all stop me? I was doing that to see if anyone was going to stop me. And y'all didn't. I remember my first boss in finance. He did this big presentation, and to get people to pay attention, he says, I put a typo in this presentation. The first one to find it gets a $1 bill. They found like 5 or 6 errors. And he didn't have enough dollar bills, but anyway. Okay, so you look at that. You know, the 10-year and the 3-year are the same. That's kind of interesting. The 10-year is much lower than the 3-year on Europe. Is that Euro Paris or whatever it is, Euro France? Anybody here been to Euro France? My understanding, everybody goes to Euro France are non-Europeans, people from Asia, United States. And then Asia is growing pretty fast. Is it Japan that has the Disneyland? So the 10-year is higher than the 3-year. So what does that tell you? The 10-year is higher than the 3-year. Obviously, the last 3 years have been slow. Now we know we got COVID in these numbers. Maybe this is October 2020. Yeah, that's last summer. Probably just destroyed them, at least on the theme parks. I'm thinking theme parks is obviously more than theme parks here. But anyway, that's the kind of thing, you look at these numbers and then you say, my forecast, and you give numbers going forward, and then you have the rationale, and that's your forecast. All right, you can do it geographically, or you can do it product. I don't know how you can do it geographically and product at the same time. That would be really tough. But pick one or the two. Either do it at the product level or do it at the geography level, and write it. This will work. You may not really believe the numbers you come up with, but at least it gives you some basis to say, oh, I can see why they're growing faster here than there. If COVID's an issue, then what can you do? You can do this entire thing again, but leave 2020 out, do it all through 2019. And then you say, okay, maybe it will come back, all right? So you can do the same thing there on the geography. You can also do the same thing here on the product level. Try to get some sense of where that growth is coming from. Procter & Gamble is the other company I brought in. Here's how they break it out. Beauty, grooming, healthcare, fabric, baby, corporate, well, the corporate doesn't matter, snacks and pet care. This data looks pretty clean. When you look at grooming, if you see grooming suddenly show up, your question is, was it part of something else before? This is 2006, so that's 15 years ago, so it may not matter. I'm only going to go back 10 years. All right, so if you see a big jump, try to figure out where it came from. Here, snacks went to 0. Can you see where it might have gone to? It's hard to say. Did Procter & Gamble just stop doing snacks and pet care? Maybe they sold off a pet subsidiary. I don't know. But we're going back 10 years, so 2011 is the key. So the key is, did anything radical change from 2011? So guess what you can do? See how I love graphs? Does it look like there's any major serious error in those numbers? That looks pretty reasonable, right? So I'm a big, throw it in the graph. You can delete the graph. I think there's some people that are excessive compulsive, but they build a graph, it's got to be beautiful, they got to use it. No, you can build a graph and delete it after you use it. It can be short-term use. And I love using graphs just to make sure something is not wrong with the data. We do that with the investment side, right? When we do the sectors, we graph our forecast, the market, and you look for outliers. The easiest way to find an outlier is you just do a real quick XY graph. Say, my word, what's that over there? Let's take that out. So this is on, when you're bringing capital IQ, it's called segments. And so I'm getting all this from the segment thing. So when you dump everything in, look for the segments, and they'll give you what they have. And then here again, I don't know where their strength would be, but again, the 3-year, 5-year, 10-year plus that divide 1, 2, 3, 4. And I don't really care about the corporate. I mean, maybe you have to put some number in there, but the corporate doesn't really interest me all that much. But anyway, I'm not going to do all the others. But you see how the math works down. But anyway, it's interesting. Just look through it. Grooming has gone down. Healthcare makes sense. The baby boomers are going up. Boy, that's an evil looking growth rate. Fabric, baby's down. So some of this is the demographic discussion up here of what do you think each one of these are going to do? If birth rates are down or whatever. So, you look at each one. If you're worried, y'all see anything that looks unusual going year to year? You would think, I don't know where they would put Procter & Gamble. Do they do any hand sanitizer type of things? Or I'm not sure exactly what other product is. I think it's Johnson & Johnson was going to do a bleach product, and Clorox just took them out completely. So baby and fabric are the 2 biggest ones. So those are the ones you got to get right. But if you find one, it doesn't show here in Procter & Gamble. If you find one that's a small line, but it's growing really, really fast, then yeah, you can grow something at 25, 30%. It's a brand new business. It's kind of like with Disney with their new online, broadband videos. Yeah, you can grow something 25, 30% pretty easily. Now, unfortunately for Costco, they didn't break membership out from the non-membership fees. So I would have liked to have done that. That would have been interesting. All right, so there's nothing magical here. You get, and you could do a graph with this, right? Just do a kind of a bar chart or something to show here's the 3-year growth, here's the 5-year, here's the 10-year, here's what I'm assuming. You could do multiple growth. This is what I'm assuming, and you have your paper on revenue is going to be your discussion of how you came up with the growth rates. You may have a section on growth rate for beauty, growth rate for healthcare. You talk each one and give your numbers. All right. Did they do international? Doesn't look like it's going to help you much. U.S. international, maybe. But if I were Procter & Gamble, my guess is Europe looks a lot different than Latin America, especially Japan. How many baby products are they selling in Japan? Well, not very many, right? So international is a little bit too summarized for me, but it's still interesting just to see, is there a radical difference in these two? The U.S. is growing a lot faster international, maybe because of Europe slowing down. Maybe Unilever. Unilever is a pretty big competitor. Maybe they're doing stuff that's taking them out in certain markets. Who knows? But I forget what other companies I brought in here. Procter & Gamble. I got Apple. For Apple, you would think product line would be the most obvious thing, wouldn't it? So what do they have on the product lines? They've got international here. You got international. I don't see anything on product lines in what they gave me. That's pretty frustrating, isn't it? That'd be the obvious thing to do. iPads, iPhones, watches. It's just not there. They don't provide it in Capital IQ. Where are you going to get it? I don't know. You can find those type of dollars. And you know they exist. You know, certainly Apple keeps track of it at that level. But I don't see anything other than international kind of numbers. Would it make sense to do Apple like this? You could, but boy, it'd make a lot more sense to do it at the product line. All right. So then you just have to give rationale for the growth rate. And that's the bulk of your paper. There's 50% of your paper. The rest of your paper is just explaining how you got that gross margin, that net margin. It really is much easier paper at the end. Questions on that? Well, for this one, yeah. You can use Bloomberg. You go on the Bloomberg, type in your company and type FA for financial analysis. One of the buttons is segments. And it's probably real similar to what Capital IQ has. So you can do that, and that can be dumped into Excel as well. So you could do that as well, yeah. Just be careful. Sometimes when they dump in, you got 2020, and right next to it, they have the latest 12 months. So make sure if the last one is the latest 12 months, you take that out, right? So that you're not like 2021, 2022, and then you're like, oh wait, I don't have 2022 yet. You know, so be careful. Look at the columns. Be careful what you have. All right, the last approach. I'm just going to show you a paper on that one because, in my opinion, this one's a little tricky just from the mathematics of it. So I think you have to think somewhat about the math. It's a really good way to present it, but I'm not sure it's a really good way to actually, unless you have some idea of how these things fit together. But this is the Coca-Cola one, and he did this approach. So revenue, and he did this chart right here. So he's doing what he's calling a factor or approach. And essentially what he said is what is going to drive the revenue for Coca-Cola? Let me list those key factors. Well, inflation is one, just general inflation. What do I expect there? How much can they raise prices? Then I'm going to break it up by developed markets versus emerging markets, developing markets. And we know people in developed markets are drinking more juices and energy drinks and waters and those type of things. Coca-Cola has those products, but still their sodas are certainly getting dinged. I forget what this one is. Revenue due to partnerships, impact of foreign exchange. That one, I'm not sure how he came up with that. That seems a little strange to me. But anyway, and then what he did, he essentially just added them. That's the part I think mathematically may not make so much sense to me. But it's a factor approach. I'm not sure the way he did it is the right way to do it, but you could certainly in your paper say, here's the factors that drive it. This is going to really push growth much higher. This is going to harm growth, but this one's going to dominate. You know, you can say, you could have factors that are going to drive growth, factors that are going to harm growth. You could do some kind of arm wrestle between the two. And, you know, so it's a way of breaking down what is important to this company. So it is an approach. Again, mathematically, I'm not sure how well it works. I do like this chart because it's a way that he summarized the key. He talks about each one of these things in his paper. So it says the above table quantifies all the assumptions discussed above. So he's going into each one of those. So a factor side gives you really clear things that talk about in the paper, just section by section by section. You might do it kind of like the way we did Porter's. So you might say, okay, first factor, you might have a range of 1 to 5. 5 means really positive for growth. 1 means really negative for growth. And you have a final summary. Factors impact on growth, 4.3, 1.2, 1.3, and then you might have a table and you bring that all together and somehow maybe 3 is inflation. So 3 is just in the middle. We'll just get inflation. And then, or however you're going to, you would do it. There's definitely no rules on this one. He made this whole thing up himself. It certainly made the paper easy to read. I was a little, especially on his foreign exchange discussion. To me, a foreign exchange forecast is 0. I expect foreign exchanges to be exactly what they are today. So I don't really forecast that. And then what does he do? He just does the other. This looks kind of familiar. You show history and you show your forecast. All right. So that's the other approach. That second one is not well defined, but do something to get from your discussion down to some numbers somehow that you can put into the paper. Those are the 3 approaches I've seen. I don't know in the industry if there is an approach to forecasting revenue. I just don't know how to do it. At USA, it was higher than last year. That was the way Bob Davis was. Whatever it was last year, add another 5%, and that's what it is this year. It's just keep going up, keep going up. If I was doing a retail store, for me, Walmart, the product level doesn't make much sense unless you're doing Walmart, neighborhood Walmarts, and Sam's stores. That might make some sense, but I'm not going to do apparel and grocery, and that just to me, it's just too much. You probably can't get those numbers anyway. So for me, for Walmart, revenue per store or revenue per square foot just makes the most sense. It's the easiest to forecast. All right, have you picked which one you're planning on using? Anybody have a 4th approach? If you think of a 4th one, let me know. I will tell you though, when you get out there in business, I remember the first time I started forecasting, you just sit down and just think about it logically. That's about all there is. You just say, how would I do this? And I can't think of any other better way to do that. All right, let me show you what I've given you for Walmart. So Walmart does have, at the very, very end, does have a forecasting component to it. And you might be able to use this for your firm. Don't use it for your revenue forecast, all right? Your revenue forecast, you just plug into this model. Okay, so what I have here for revenue is just entirely not sufficient enough. So what I did here is I looked at the growth in square feet, and I looked at the revenue per square feet. I looked at that over time, and then I just forecast numbers out. So revenue per square foot has averaged about 4%, but the last few years, its average has been 0. So my 0.5 is actually pretty high. The revenue growth, I'm sorry, that's the square feet growth. Okay, square feet growth has been close to 0. I forecast that 0.5%. The revenue per square foot has averaged 0.56%. I'm using 1.5. Why? Something close to inflation. So neither one of my numbers matches this one. Now here you can do a graph. It's not going to be a very good looking graph, but you can do a graph of this if you just want to know. And just looking at it, does it look radically unreasonable? I hate to be cynical. I really think that's what it comes down on forecasting. Does it look radically unreasonable? If not, then it's a decent forecast. Okay, because nobody knows. Same thing with revenue per square foot. Does it look like a radically unreasonable forecast? Looks okay to me. So it looks a little aggressive, but it looks okay to me. The other thing you do if you go to the graphs, I built the graphs for you. So there's my revenue forecast. Again, does that look reasonable? Your boss is going to say, I can't believe that's your assumption. Probably not. Probably going to say, yeah, that looks reasonable. Okay. And I do think that's what we do. We just tend to extrapolate. We do all these fancy models so that we get a nice straight line. We could have just drawn a nice straight line. That's what we did at UTSA. We did all these fancy models. Bob Davis said, no, that. So, okay, we should have just started with the straight line. All right. And then going down, what I do, here's my GM ratio. I looked at it over time. I looked at it recently. Again, I graphed it. Here's my gross margin forecast in dollars, my gross margin forecast in percents. And just looking for something that stands out. Did the same thing on the operating revenues, looked at them over time, just to make sure that looked reasonable. And again, if you have your scale wide enough, everything looks good. But I essentially took the average of the last few years. So y'all can see how fast this goes. Once you get a good revenue forecast, boy, you just start selling really fast. Operating income is just here's my miscellaneous item. They've averaged negative $1 million, but they've been really large the last few years. I just plugged a number in. I don't really know what they are. In reality, I had to go and research those and see what they are, see if I can figure out what's going on there. They had something radical happen this last year that caused some noise and distortion. Here's my EBIT margin. That's a pretty important graph to show. The EBIT margin looks pretty conservative, doesn't it? Would my boss question that? Yeah, that might raise some concerns. Why don't you assume they'll get back up to where they were? Well, I'm going to say, well, Amazon. Right? Amazon showed up. It's much more competitive. It's getting cutthroat. You got Home Depot and Lowe's taking a big chunk of your business in specialized PetSmart. Yeah, it's much tougher. You got Amazon on one side, you got specialty shops on the other side. So yeah, I just kind of flatlined that new environment. Does that sound rational, reasonable? You know, I don't know what I'm talking about, but boy, I can make it sound like I do. That's part of being a finance major, that debt. So here, interest expense, what do y'all notice I'm doing there? I'm multiplying by what? What do you think U81 is? That's their debt. Why don't I multiply by this year's debt? What is Bill Gates going to tell me when I hit enter? Now I know they have this circular reference thing. I don't like using it because I don't understand it. Bill Gates tries to help me out there. I already knew that was gonna be a problem. So I just used last year's debt to get the number and see what I can get. I then get my earnings before tax, I get my income tax. The tax rate went up. Or I expected to go up under Biden, and so I put that in there. Net income, I do a net income margin. Then earnings per share, I'll have to explain how to do earnings per share later because we have to look down at those numbers. It's going to be an issue for some of your firms because you have a lot of stock buybacks you have to do. Now, I cheated here and I put CFO all in one number. When I do my Costco class, we're actually going to build the detailed CFO statement because we want to know CFO, we want to know cash for investing, cash for financing. We're actually going to break it out into different pieces. But here I just took the CFO by itself and did some graphs. So I do graphs for a lot of these. I did not do a graph on the CFO as percentage of net income. You know that it should be above 1 because their net working capital is a source. But again, it looks, you can see how graphs are really, really powerful for you. They're going to point out some major error really, really quickly. All right. Okay. Then we got to do the balance sheet. So how are we going to get this balance sheet to work? Well, some balance sheet items are a percentage of income statement items. They're pretty simple. But some balance sheet items are a percentage of total assets. It's kind of hard to forecast asset items that are a percentage of total assets without getting the circular formula. So let me tell you the approach when I started my career. The normal approach was forecast everything and then plug it all either to other assets, to cash, or other liabilities. And that was the approach. I remember the first forecast I got from Jim. He's still a good friend of mine on Facebook. So Jim, an actuary, he did USA's forecast. This was for the life insurance company. I go, Jim, why are you forecasting this massive other net worth 7 years out? It's like, it's usually like a few $100,000. You got it like at $32 million. And what was his answer? That's my plug figure. Oh, okay. Well, if that's your plug figure, that must mean something else in your forecast is wrong. Because we don't expect that number to go to 32 million. What are you going to tell management when they're saying, why is other assets suddenly 17 million when it's never been over $1 million? So I didn't like that. So I started my own consulting firm and I got one client and then I quit. So, but this one client, they asked me, this is a firm that wanted to get into business, do business with property and casualty companies. So they asked me to build a forecast model for a P&C company, and they had an actuary that was going to make it stochastic. I couldn't do that part. I'm not an actuary, but I could build the basic guts of the model. I built the whole thing. I'm building. Someone took my P&C class, Schedule P's. I had Schedule P's going all over the place and all this. So I had this really good model. But then I get to the balance sheet, how to get the balance, and I didn't like that massive plug figure. So I came up with this approach. I don't know if anybody uses this approach, but here's my approach. I think it works really well. So look at my other assets. My balance sheet balances. Does this look like a reasonable forecast? So it worked, right? So my approach avoids that. So let me show you my approach and see if you can figure this out. Some of y'all had my 3013 class, so you already know what this is, but how did I get it to work? So I took V62, V65, and V68. What do you notice about V62, V65, and V68? V68 is just a keyed in number. What are 62 and 65? They're current assets, but how did I come up with them? Off the revenue. So they're coming off the income statement. That's kind of nice. That's not going to mess me up. All right. So I took the sum of those in dollars. So my numerator is dollars. What is my denominator? V71. What is V71? Percentage of other assets and percent of assets. What's P74? A PP&E. So I'm taking the dollars that I have forecast in dollars divided by 1 minus the 2 that are percentage of assets. What is that number going to equal? You take your dollars that are not a percentage of assets and divide it by 1 minus your assets that are percentage of assets, what will that equal? It's going to equal total assets. All right. So this is it took me 1 week to do this project. They paid me $10,000, which doesn't sound like much, but that back in today's dollars, it's probably like $30,000. They paid me $30,000 to do a forecast model, and I came up with this approach. They saw my model. The actuary was a life actuary. They decided not to pursue that business. So I saved them a lot of effort and time. They were like, wow, I didn't realize this business was so complicated. So yeah, it's pretty tough. All right, so I get my total assets, and now that I have a total asset line that doesn't rely at all on circular formulas, I can now do my other assets as a percentage of that number. So my other assets is at 25% times that number, because that number only uses the 25%. Y'all see how that works? I avoid the circular formula by doing that. And then I add up all my assets, and sure enough, it matches. There's no issue there. All right, so that's my approach. I'm not saying you have to use this approach, but I think it works really, really well. So how did I forecast everything else? Well, I did accounts receivable as percentage of revenue. Any debates on that? That's pretty straightforward. And we know accounts receivable is not a big part of Walmart's business. The next thing I did, inventory as percentage of cost of goods sold. That makes perfect sense, doesn't it? Goodwill, I just plugged in there. Other assets, I look at the history. Boy, that looks like a pretty high forecast, but something happened, all right? So that's the one I'm a little nervous about, because something major happened this year. This is the one I would probably go look at the quarterly statement to see if something came back. But anyway, I'm going to have an offsetting one on the liability side. So, it's not going to really distort anything. I just got, they're inflated. I got 2 other lines inflated. It's really not that big of a deal. PP&E, it's, what he used. I got some, again, it looks like something happened this last year, like they sold off a major business. Cost of goods sold, accounts payable, I do a percentage of cost of goods sold and expenses. Now, what I'm going to do in my Costco class, what I like to do is I like to take each balance sheet item and do it as a correlation of different things on the income statement. And I'm just curious, where's the highest correlation? The correlation is going to be really, really high because you have a business that's growing over time, so everything's going to be correlated. But one item might have a correlation of 0.99, the other one might be 0.92. So I just go, okay, this line item is more correlated to SG&A than it is the cost of goods sold. So I'm going to use SG&A to forecast this one. That's the kind of thing I do. Just real quick, calculate the correlations, see who has the highest, and just go with that. And then I get the debt to equity. There's my debt to equity number. What is my debt? My debt then is going to be my debt to equity ratio times my equity. Then my net worth is just my assets. My beginning. Oh, there I can't remember how I did that. I have to go look that up anyway. I may have taken net income, subtracted dividends or something. I can't remember exactly what I did there. Let's look real quick. So prior year's net worth plus V48, is that net income? Plus net income minus dividends and stock purchases. So I just did that. That may not be enough for some companies. They may have other things going on, but it worked fine for Walmart. Right. So you probably could use this financials for your company. For a lot of you, some of you, it may not work so well if you have some other lines going on. Down at the very, very bottom, this is where it gets a little tricky. I did dividends as a percentage of net income. Looked at the history and just forecasted out. That's where Costco, you guys doing Costco, you're probably going to have like 5%, 5%, 40%, 5%, 5%, something right, kind of look at the pattern. And then I did dividends and stock repurchases as a percentage of net income, and then just backed into the stock repurchases. This to me is not such a big deal. If you get off on them a little bit, that's not a big, I'm fine with, look at history and just forecast out. And then I just have a lot of ratios at the end. And then I have graphs, ATO graph, ATO times margin graph. I got my margin graphs, I have a return on equity forecast. You can build others if you think are important to your firm. But You can use this Walmart spreadsheet for everything but one thing, and that's the revenue. You've got to do the revenue as a separate thing, right? So if all you do in your paper is come in here, I have students, they come in here and they don't even change these numbers. So their forecast for their company is my Walmart 2% growth in revenues. So that's not gonna fly. You're not gonna get a good grade with that. You've got to justify your numbers, all right? So this is just completely made up for 10 numbers here. The thing that I think is kind of questionable in some of these, if I can find one, but you're sometimes gonna have a graph that you look at it, you go, wow, that's unusual. If you can't explain why the graph's doing what it is, let's say their ROE is really shooting up, but that wasn't what you were really expecting, then either you got to come up with a rationale. So you're expecting your ROE to stay flat, and instead it's growing. You can kind of make up something, make it sound good, but probably more than likely you've got something in your forecast that's off. And little things can make a big difference. You might have on your GM ratio, maybe it's been averaging 27.8 and you just rounded up to 25. That can be huge. That can be the reason why you're showing this great increase. So be careful on things like that. These assumptions, they look small, but small changes in these assumptions can have a huge impact. All right, we will finish up this next class, but that should give you enough that you've got papers 2, 3, and 4 ready to go. So next class, we'll look at some other papers and do a little analysis, but you should be ready to go on that. All right. All right. I'll let you go.